Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 6, 2022. As always, please don't forget to hit the like button, subscribe to this channel, and share this video with others. These actions are what keeps this channel going. Stocks made a lower low following quite a volatile trading week. I think they're in a bear market, and I'll show you what I mean. Easily another 13% down for stocks before some sort of a bounce might materialize due to market breadth. I'll show you what I mean there. How to sell short. I'll give you an example of General Motors, just a perfect example. High yield bonds are leading the stocks lower and they just hit fresh 2-year lows. This is bad for stocks, obviously. And mortgage rates again rising to highest not seen since 2009, and we'll look at long-dated Treasury bonds and the Treasury yield. And dollar strength is weighing on precious metals. Could it be coming to an end? We'll try to try to figure this out. And Bitcoin looks really primed to collapse towards like 10,000, especially if it closes below 33,000. If you are a subscriber, stay tuned. We're going to cover lots of various securities, crude oil, natural gas, copper, some of the bigger stocks, and then also on the speculative front, we're actually starting to sell the stocks short. So I'll show you how to do that, and stay tuned for that. So number one, how do we trade? The way I trade is by using I'm sorry, I still have a cold. I'm still using my own private trading indicators called MasterCharts Trading price action indicators. They're on this chart. They're green, blue, red, and yellow lines. So they show basically levels of where I want to be buying or selling. By extension, they become support and resistance. So looking at this chart, this is S&P 500. The way to interpret this price action is as follows. Number one, this is a daily chart. You can see it daily. 1 day. So each candlestick is 1 day's worth of activity. On this date right there, 29th of April, this security, S&P 500 E-mini futures, probably the most important index in the world, has closed below this level of the yellow line at 4159. This to me means we have entered a bear market. In other words, we have begun a downtrend. Now, of course, some of you will argue that, well, the downtrend began right there on the 4th of January at the all-time high. But good luck catching it. So at that point, it was still an uptrend, and the downtrend, stocks switched into the downtrend per my system, per my understanding, right there, 29th of April. So at this point, we're thinking, okay, definitely I do not want to be buying for a long-term hold for sure. I want to be thinking about how to sell them short. And the way to do it is to sell stocks on a bounce. So right now we're near the lows of the move. So it's possible they're going to continue lower from here without any bounce. It's entirely possible. However, it would make more sense and be less risky to sell short on a bounce. And where can we expect that a bounce to materialize? Where can it go? So I just turned on my experimental 6.0 version. They project indicators into the future, and you can see that the indicator lines kind of curve up a little bit, and the magic number is, I'm reading it right off the chart, 4338 for S&P 500. So I think it's very possible that we're going to bounce, but if we get to this level at 4338, the red line, I would be thinking about selling it. In other words, opening a short position by buying puts, or you can also buy inverse ETFs, for example, for S&P 500. That's another option for people who don't have a possibility of trading puts or buying buying puts. Now I don't want to be selling calls. I mean, some people want to sell calls, which is fine with me. I don't want to be doing that because of the unlimited liability. If you buy puts, you only are, the worst thing that can happen is that you will be out of your however much you paid for the puts. So the way I'm looking at it again is I think we're gonna bounce, and then we're gonna start thinking about selling short around 43.38 from current levels, basically. Looking at Dow Jones, I mean, enormous candlestick right there yesterday on May 5th. I mean, look at the size of this thing. It's just enormous. One candlestick was 3% move, or over 3% move, you see. So the same goes for this chart for Dow Jones. So the bear market right there, it started right there 29th of April of this year. We had actually even an earlier indicator right there on 8th of March, but then we had a whipsaw to the upside and a positive signal. So for sure right now we're looking at 29th of April. And again, I was looking more towards S&P 500. Dow Jones is kind of a nice index, but S&P 500 is more important. So looking at Dow Jones at 29th of April right there, already bear market. If you were able to sell it short right there at around 33,904 on May 4th, and maybe like a couple of hours of May 5th at the beginning of the session, and then you would have already made good money there. But it's kind of tricky, so I mean, you can see there was no arrow, so I didn't really send any alerts. And once again, I think it's possible that we're gonna bounce. NASDAQ is one of the weaker sectors. So NASDAQ again entered the bear market right there on the 8th of March, where I'm hovering. How do I know? It entered the bear market because it closed below this yellow support resistance line. You can find out more about them. This is just, I programmed them in, and so you can have them on your chart. These indicators are available for TradingView.com. So find out more by looking at the description of the video. We had a bounce. So where do we sell short? We sell short on close below this red support resistance line. This occurred on 8th of April. And you have, I mean, just a beautiful sell short signal, and that's 13% move in your favor. So if you bought puts, you are in great shape already. Again, it's possible because of the correlations, S&P 500 and NASDAQ and Dow Jones and small caps will all bounce. But again, they are bouncing within the bigger downtrend. So I'm looking for a bounce, but I'm looking to sell it short, just like we just did here on April 8th. So again, enter into a bear market on March 8th, bounce, and then a signal when we have a close below the red line. So that's all we need to know. We don't really need to know anything else. We only need to know where are we with regards to the lines, where the price is with regards to the lines. Russell 2000, the weakest of the bunch, entered the bear market right there on January 18th. And we had 3 opportunities to sell it short, marked by the arrows. The stop would have been above the blue line, so let's say you shorted it right there on 30th of March or even on 5th of April. Nice, beautiful move to the downside, and now a new low and a close at new low. So very bad sign. A downtrend is a series of lower lows and lower highs, and it looks like we're just beginning this process. All right, so next what I wanted to show is market breadths. So here in the upper part here, we have what's called New York Stock Exchange advances less decline volume line. So every day you can find out more about this by going to chart schools and then type in advanced decline line, and it will tell you how it's calculated. It's not my thing, but I use it. So what we do is every day there is a certain number of stocks on the New York Stock Exchange composite index, which go up. In other words, they have positive volume or positive number that they went up. It means advances, and there are also declines, those stocks that went down during the same day. And so we subtract declines from the advances. In this case, we subtract the volume of the declines from the volume of the advances, and we get a number. And then the final thing is that instead of it being like a raw number, I'm going to show you what I mean. So a raw number would look like that. It actually makes no sense. It's just a number. So what we need to do is we need to do what's called cumulative. We need to add this number to yesterday's number. So we got this number of advances less declines, and we're going to add it to yesterday. And so we're going to generate this kind of line. And so this line is what's called advances minus declines volume line. And you can see that it dropped below previous highs. Now in the bottom here we have S&P 500. So notice where the line just ended on this week. It ended actually below many previous lows, and it's at the same level as in November of 2020. So just based on this chart, we can say that, okay, so that was the number back in 2020, and what was the level back in 2020? So that was at 3,600. So I'm estimating that we're gonna get somewhere in the vicinity of, so this is the move. This is a weekly chart, so I wanted to show you like a zoomed out version. So it looks like we're gonna continue lower, and this is just based on the market breadth. So it's extrapolation, but easily another 13% down towards 3,600 here. It may or may not happen, but it's a logical target, I think. It's also a breakout level. You can kind of see there was a breakout here back in November 2020, and then we had a new high in beginning of November 2020, and it just kept going afterwards. So that's, one way to project it, one way to think about it. Okay, so how do we sell short? So now that S&P 500 has entered the bear market, most of the stock markets around the world are doing the same thing. You don't need to know anything about anything. So the easiest way to do it is as follows. Find a stock that ideally doesn't have dividends, but does have options. And it also has quite a bit of volume. So for example, General Motors has a significant amount of volume, and it's a very common stock. People trade it all the time. So on this chart, we saw that right there on the 28th of January, we had a close below the yellow line. So that's all we needed to know as far as when did the bear market start? When did the downtrend begin? And the downtrend began there at 28th of January. Then what we do is we wait for a bounce towards the red support resistance line. Again, you need this line, it's MasterCharts Trading price action indicators. You'll just simplify your life so much. We bounce towards that level, and this is where we sell short. So we need to see a high above the red line. It can be a close above the red line. It could be a high above the red line. As long as we're below, as long as we first close below the yellow line and haven't yet closed above the blue line. You see, we stayed below this red line. We came up and we closed below the red line. Okay, it's pretty obvious in the chart. That's where we sell short. We would have sold short on the 2nd of February. I did not trade this particular stock, but that is a great illustration of the principle. And then we do nothing. We just sit in the position. So let's say we bought puts right there. That's a 31%. Stock lost 31%. Let's say you bought puts 1 year out. It could be easily 3 times that much gain. So you could be sitting on 100% gain right now. for General Motors if you sold it short on February 2nd. Right this instant, it's possible that we're gonna get a move higher, but my stop would be at the red line. So I would be taking profits definitely, as we need to make new lower low, but overall I'll probably just keep the position open, just depending on how far you have the options out. Or you can also sell it short if you have a margin account and you can borrow the stock. Does this make sense? If it doesn't make sense, or if it does make sense, make a comment, and also you can send me a message as well, right here on TradingView, or you can go to MasterChartsTrading.com, MasterChartsTrading.com, then click on Help and send me a message, and I can explain pretty much everything about this. Alright, junk debt. So high yield bonds, as I never get tired of explaining, have high degree of correlation to the S&P 500. So let's look at junk debt. Here's JNK on weekly time frame. In other words, each candlestick is 1 week's worth of activity. And down here below we have a correlation coefficient. So that's how much does junk debt correlate to S&P 500, and you can see it correlates quite strongly. In other words, whatever junk debt does, S&P 500 almost always does the same thing. In this case, high yield bonds went into a bear market right there, January 18th, and they were really the first canary in the coal mine, and really strong selling. It was barely any bounces. So usually we try to sell short on when we touch the red line. We didn't even touch the red line. We kind of came close here in February, kind of came close here in March, and just continued to collapse. Lower lows, lower highs, lower lows, lower highs. So right now we're in pretty bad shape as far as junk debt is concerned. So we are back to levels not seen since the pandemic, since April of 2020 here. Can we bounce? Yeah, sure, but we're in a downtrend. So once again, we're going to be looking for a bounce and then think to open a short position. It probably doesn't make sense to sell short junk debt because of the dividends, but if you really are hell-bent on shorting, then that's you can do it. Okay, so looking from the junk debt, extrapolating to S&P 500, not a good sign. Looks like we may continue lower for stocks, and I don't see an end to this yet. Looking at Treasury bonds, TLT, so this thing also unraveled. You can kind of see a couple of opportunities, one right there in January 18th, another opportunity to sell short on February 3rd, a great opportunity to sell short on 1st of March. You will have been 20% richer if you just shorted the actual underlying, but again, if you bought puts, a year out, let's say, that's easily 3 times, so that's 60% gain. And I just made a new low. We keep making new lows. We have no strength whatsoever in the bond market. In fact, looking at mortgage rates, this is mortgage rates for 30-year fixed rate mortgage, and this is going back to, zoom out quite a bit. That's a 12-year high. You see, this is the level since we haven't seen since 2009. So a huge move. I think it will finally put a damper on the real estate prices and just insane rents. Today I talked to a friend here in San Francisco, and he moved into a 1-bedroom apartment on the first floor. It's not a big apartment, it's just okay. He is paying $3,500 for rent per month, you see. So that's how crazy the rent is, and how crazy the mortgage, the real estate is. So possibly this will finally, stop the insanity. So in a sense, higher interest rates could be good for some some people, higher interest rates could be bad for some people, because if you're trying to buy a house, you will be able to afford less of a house, and so you will be priced out. This is called demand destruction. But looking at the bonds, this is Treasury bonds and Treasury yields move opposite directions, and mortgages are tied to the yield on the Treasury bond. So yes, it makes sense that Treasuries are dropping while the mortgage rates are rising. Looking at dollar index, so dollar, I have showed this chart in the past. I'm going to show it again. Here's dollar index. This is a weekly chart, so each candlestick is a 1 week's worth of activity. You don't have to be a rocket scientist to see when the stock right there closed above the blue support resistance. This is an inflection point. So once it does that, that means we're switched into the different trend, in an uptrend in this case. From here on, from July of 2021, we say, okay, this is it, we need to be buying. And so the great opportunities to buy were right around the blue line. So maybe as far back as September 3rd, September of 2021. And notice this huge run for the dollar. Now, looking at gold, so we do trade gold at MasterCharts Trading, and gold normally works the opposite. So if dollar goes up, gold normally goes down, because it's XAU divided by USD. So if the lower part of this equation, US dollar, is getting stronger, it will pull this currency pair lower. So up until very recently, up until about March 7th, it actually didn't make any much difference. Gold was going up, but then something happened, and I think the dollar just really started pressing on gold, and we saw a pullback, and now we're pulling back pretty significantly. These are actually approaching all-time record highs. So hopefully we're done. Looking at the dollar, it's really difficult to say if we're done appreciating. Could we continue higher? Absolutely, but it does look somewhat overdone. So maybe we'll finally get a pullback. If we do get a pullback, gold better take advantage of it, because it so far has failed this level at 1923. So I'm going to zoom in on daily charts. There is support resistance at 1923. How do I know? It's the blue line. So this blue support resistance line, it acted as a very nice buying opportunity right there. On 31st of March we bought, and then 17th of March. Actually, you got your target on 18th of April right there. But then something happened, and on 25th of April we saw a breakdown. In other words, this support resistance line no longer held the support, and we continued lower. So right this instant we're sort of in between. Bear market for gold is at 1825. And again, I'm reading the right of the chart, 1825. And another bullish opportunity, in other words, if we close above 1923, there's a very good chance we'll continue higher to new highs, turn towards new records. Right now we're literally in the middle, and we're stuck. So we're watching and waiting right now. And to wrap it up with Bitcoin, so for some reason I'm getting like negative feedback for people. I guess they're like Bitcoin lovers, I don't know, but I don't care. It's bearish. So we had 4 opportunities to sell it short. You can obviously see it on this chart if you have eyes. We short and close below the red line where the arrows are. Pretty obvious, right? The latest opportunity was actually very nice as well. You would have been already 24% richer if you sold it short. Now I want you to take a look at this level right there. It's 24th of January low, which is around 33,000. So I think if we don't hold, if we continue lower, and I think we will retest that level at 33,000, I think we'll collapse to like 10,000, maybe even lower. So I don't want to be holding any Bitcoin or any of the cryptocurrencies or whatever, even if some famous person holds it, even if El Salvador uses it as a currency, even if California right now is talking something about cryptocurrencies, I don't want to be holding it, because if it collapses, I will be holding a worthless security. Why would I want to be doing that when I could be holding, for example, dollar, or worse comes to worse, gold, or maybe even have sell short stocks? You know, why would I want to be holding a losing security, for example, Bitcoin? So think about that. Again, if you have any questions or comments, make a comment. Don't forget to hit the like button again. And then if you are a subscriber, stay tuned, and I will release a separate video. But once you're ready, head over to MasterChartsTrading.com, click on sign up, and sign up for one of the products. I have basically 4 packages. One is trading indicators, so this lines on the chart, the green, blue, red, and yellow lines, which will greatly simplify your trading. You only need a free TradingView account. So this interface right here is called TradingView.com. You only need a free account there. Once you sign up, you will get a user ID. Send it to me, and I will open the door for you on TradingView. So, of course, sign up on my site. $29.95 per month is not very expensive. If you want just the newsletters, so again, if you are interested, I have newsletters that I send out daily, and also a weekly video as well. So separately, we send a video on Friday or Saturday for the subscribers only. And of course, the best deal is to get both trading indicators and newsletters. So right now, $59.95 per month. I think it's a great price. And of course, if you need a personal access to me, you get 60 minutes one-on-one screen sharing session via Zoom. It's at $259.95 per month. So consider signing up for that. Again, if you have any questions, please let me know. Thank you for watching, and have another great trading week. Bye-bye.